Now today I want to start a little bit of chapter 19. So I know next week is midterm, so we're just going to go through the first section of chapter 19, introducing a little bit of the new concept here. So chapter 19 we're going to focus on not that much on assigning the cost to products or understanding the cost flow, but rather we're going to link this cost information to sales side. Okay, so the first three chapters we talked a lot about understanding cost flow from materials, labor, manufacturing overhead, and then how do we compute the total manufacturing cost and then assign it to different jobs, right? So this chapter here, we're going to link to the relationship between these cost information and sales volume, and then later what is the sales profit that we're getting. Okay, so the relationship between sales and cost, and then we're understanding cost in a different way, not just by its physical characteristics. Remember earlier we classified cost into materials, into labor, manufacturing overhead, which really is the characteristics of the cost itself. What is it useful in the manufacturing cycle? Today we'll be understanding cost in a different aspect. It's still the same pool of costs, it's just we look at it in a different angle, classify it based on the stability of the cost. Is it a cost that changes based on the volume of sales, or is it a type of cost that stays the same regardless of sales activities? Or perhaps the type of cost is a mixture of both of these features. Okay, so the first section we'll be going over what are the different types of costs based on whether it fluctuates with sales activities or other activities or not, or is it a type of fixed costs or a mixture of costs. Okay, so first up here, there are three types of costs: variable cost, fixed cost, and mixed cost. So the variable cost part, obviously, as opposed to fixed cost portion, variable cost basically goes up and down based on the certain types of events or activity that happens. So we covered in ABC costing system. Remember that we separate costs, the different stages of manufacturing line, into different activities and find a driver for those activities. So those examples we went over earlier falls under variable costs. Remember, the more machine hours being used, the more DVD burning cost is accumulated. That's a type of variable cost. Other examples, the more number of inserts being done for this type of job, the more case assembly cost incurred. So those are examples of variable cost under the manufacturing cycle. There's also variable cost under sales and advertisement costs related. For example, sales cost, delivery truck. If you have a truck that delivers the goods, of course, the heavier the goods are, perhaps the more cost incurred. Or the longer the distance between the company and the client's place, then the more cost is incurred for delivery. So variable cost is the type of cost that increases or decreases in proportion, and it's related to a certain type of activity that happens in the business. Now, fixed cost, general idea is stays the same rate regardless of the activity. So even if you have none of the events that happen in this season, or you haven't sold anything out, there's still some portion of the cost that will incur no matter what. Mixture of the costs, we'll go over that in more details a little bit later. Okay. So again, variable cost, the detailed definition will be the cost that changes in proportion to changes of certain activities. So typically the one we're introducing today will be sales activities. What are the type of costs that will change based on the number of sales that we make to customers? For example, cost of goods sold. The more you make sales to customer, remember we always journal 2 entries on retail price, on cost of goods sold. So the cost of the inventory will be accumulating. Cost of the inventory that's sold out to customer, that account will be accumulating as sales entries goes on. Whenever we make sales, we accumulate cost of goods sold. And whenever we deliver products to customer, we accumulate delivery costs. So the more times we'll be shipping the goods, the more cost of delivery is accumulated. So these are the costs that are linked to a certain event. The more that event happens, the more the cost will increase. Or if the next season there are lesser sales, then we have lesser types of variable costs incurred or accumulated. Okay, so again, earlier ABC costing systems, we classify activities, find the drivers. That's the idea of understanding variable costs as well. So those drivers are the activities that are basically the factor that links to the accumulation of that type of cost. So the number of jobs being accumulated, the more setup cost incurred. So that's the idea of variable costs. But earlier we just focused on manufacturing cycle. Now don't forget that for selling and also marketing the product, we also have variable cost incurred. So variable cost, this term incorporates a portion of manufacturing cost, a portion of sales cost. We're not separating those two anymore. We're looking at it together and separated based on its stability. Okay, let's take a look at this table here. So what does this tell us? What is 15? The number 15 that you see in all three rows. Cost per, it's an equipment rental cost, and it will incur for each and every event that's held. So assuming this is an example taken from the textbook, the textbook case basically is a company that does DJ services. So does DJ services for wedding, for different types of parties. Whenever there's customers request on these service, they need to rent a certain type of instrument or equipment for the event. So this $15 here is the cost of renting that certain type of equipment every time there's a customer's request that comes in. So meaning, if this is 3 months of information, we see January 15 events, February 20th, 20 events, and March 30 events. Obviously, the month that would incur most rental cost would be March, because there are more number of events that happens that is requested from customers. Okay, so this is a simple idea of variable cost, that the total equipment rental cost is accumulated based upon how many events that are requested from customers. So the more number of events we have to held, the more equipment costs would incur. Okay, now if we were to plot those three information here in this graph over here, x-axis is the number of events that happens, and the y-axis is the total cost accumulated. So we can plot them. You can see that it goes up and it has a certain slope in this graph. Does anybody know how to calculate the slope of a graph? What would be here and what would be here? Slope means how this graph is being changed, the rate of change, the rate of increase. X over y, so we would be looking at the changes of x, which is the changes in the number of events, and then the changes of the total cost. So what does this mean? Meaning, what is the rate that will be charged per event? It's $15. And how do we get this? Let's say we don't see the table up front. We just look at this graph here. We can actually go backwards and realize what is the rental cost per event by looking, just simply selecting either two dots. So let's say we select those two dots, the first two ones. So the changes in number of events is 20 minus 15. What about the changes in the total cost? It will be 300 and 225, right? So the differences in the cost based on over the differences in the number of events that's held, basically, does this equal this? Does it not? This will be 5, right? And this part will be 75. No problem. Okay, so how you calculate the slope of the graph, if you don't see the table, you want to understand what is the increase rate. You just pick any 2 points, find the changes in the x-axis, and then use it to divide the changes in the y-axis, the total cost. So you can do the same thing for the other two dots. So if we take a look at the 20 and the 30 events, the changes again, x-axis changes, 30 events minus 20 events. What about the total cost? 30 events, we have the total cost incurred 450, right? And then minus the 300. So you will get the differences here, 10, and use it to divide 150 to get, again, the slope is $15. So what is the slope? The slope is the variable cost per unit. It could be, another example, machine maintenance cost based on how many hours the machine has been used. So you would be able to determine per hour of using the machine what is the cost of maintenance that incurred. Basically, this is the slope, the increased rate of the graph. Okay, so the idea of variable cost is, again, the more you use a certain equipment, the more cost is incurred. The more hours you use a certain machine, the more maintenance cost is incurred. Okay, the more pounds of the delivery products, then of course the more delivery costs will be incurred. Now, why did we start the graph over here? Why is this line linked to the 0? No event. Exactly. So the idea of variable cost is if there is 0 events requested for customer this season, let's say it's low season, then of course we don't need to rent the equipment. None of this cost will exist. So we start from 0. Okay, so as opposed to this idea, what is fixed cost? Fixed cost, you would see a graph not like that, but simply a flat line, and doesn't start from 0. Okay, later on we'll go over the graph. But here the idea of fixed cost again is regardless of the sales activities that happen, there are some types of the cost that will accumulate no matter what. For example, straight line depreciation on certain assets. Anybody still remembers what is straight line depreciation? If we were to calculate straight line depreciation every year, you need the information of the assets value, right? Assets cost and what? Straight line, we distribute the cost along the useful years, remember? If the asset is useful, we deem it useful to be used for 30 years. And if the cost is $3,000, then every single year we list the depreciation, $100. Okay, so straight line depreciation, we're using the assets cost divided by the number of years, the useful years that we think this asset will be usable in our business. Okay, other examples, if it's $1,000 and you think it can only be used for 5 years, then every single year you will be depreciating the assets by $200. So what does this mean, 200? How it relates to this, the cost of the product. Still going to be 200 no matter what, exactly. So this is not related to the number of sales we make. Remember the 150 times, the 15 times, 30 times, or 10 times of the events requested from customers. Regardless of that, this depreciation would always be journalized every single year. Again, of course, this is an estimation based on the estimation of useful years. But as long as this asset, when we first purchase it, once this is determined, every single year, no matter how many sales activities happens, we'll be depreciating the same dollar amount. Okay, so this is the idea of fixed costs. It will incur regardless of how many events that actually happens, which is why that the rate, you can see the graph, it has a straight line and it doesn't start from 0, because even though there's no events requested from customer, we still depreciate the assets such as furniture, the building that we rent. We have to depreciate it no matter what. Okay? Now, what about this column? So we talked about the same rate, which is related to total fixed costs that occur every single year. You can see that no matter how many events, numbers requested from customers, we still have $12,000 fixed cost incurred. Now, what is this? The cost per event, and why is it different? Because this is the part that we're trying to, remember, assign to different jobs, right? So this goes back to, again, like the assignment of costs, And since it's fixed cost, it's not really accumulated based on the number of events. We just equally distribute it to different jobs. So if we know that we have fixed cost $12,000, and this season there are 15 events that happens, we just divide it by 15 and assign this number here, $800 to each service. Yes? Say that again, sorry. Yeah. You're talking about units of production, another type? Very good questions. I was going to talk about that a little bit later. So straight line depreciation is the only one that falls under this fixed cost idea. So we still have, remember, two more depreciations, right? One is units of production and another one is, there's an accelerated rate, 2 over the useful life, remember? Okay, so let's just leave the accelerated rate there for a minute. Units of production is the cost of the asset, again, divided by the expected units that will be used, remember? Like the delivery truck's cost and then divided by 100,000 miles that you expect will be used for this year or for the entire lifetime of the asset, and then you use that rate to multiply whichever quantity is being used, which is actually pretty similar to ABC's concept, right? So in that case, that would not be fixed cost. So units of production would be a variable cost because the more the truck is being used, the more miles being driven, the more depreciation costs will be accumulated. Okay, so excellent question. It's different from straight line depreciation, so, which is why here I just simply listed straight line. So it's not all types of depreciation. Okay? Now, salaries for employees, if it's a full-time employee, their salary agreement is basically already decided up front when the person is hired, then it is a fixed cost that will incur in the business every single year. But later on we'll talk about another type. If it's salesperson's salary, then usually it's a fixed cost, and then adding upon that we may have commissions. So that will be a different type of cost. It will not be exactly fixed cost. Okay, so here the main point here is that total fixed cost would always be the same, but the cost assigned to different events every single year, to different events in different seasons will may be different based upon how many events that actually happen in a year. Okay, this is just the assignment per, this basically is unit cost per fixed cost. Okay, so we have variable cost that changes based upon sales activities. We have fixed cost that doesn't change regardless of the activities, that number that happens. Now, the idea of mixed cost is just by its name, a mixture of both features. So you can think about this example, a real life example would be your cell phone bill. Okay, how is your cell phone bill determined? By the plan that you have, and oftentimes people may have, for example, family plan and then a data plan. If you have iPhone, I'm assuming, data plan perhaps will be $30 per month. Family plan, let's say an additional line, $10 per month. So if this is related to 700 minutes, let's say, and this is related to 3 GBs of usage, as long as you're within this threshold, usage threshold, every single month you'll be charged definitely $40 at least, right? So this is a portion that is considered fixed costs. No matter how many units you talked on, how many number of minutes you talked on a phone, as long as it's within 700 minutes, you're using data within 3 GB, you will have $40 of cost incurred. So basically, the more you use, the better off that you're utilizing the plan. But what if you go beyond this? Then it will become variable cost, right? The more number of minutes you talk on the phone, the more you're paying. So the idea of cell phone bill is a mixture of both of them, because you have a certain threshold below it, it's considered fixed cost, and then above it, the more data you're using, the more you're paying for it. Okay, so this graph here, you can see that it's not starting from 0 either, because there's a threshold. For example, the 700 minutes or the 3 GB data plan, it could be $40, $10. Below that, this portion here is the part that costs that you always need to pay. And then above that, the more you use, the more you're paying. So some of the utility bills may also fall under this category. So if a company has salesperson and they give cell phones to each of these salesperson, you may not be exactly able to estimate their cell phone bill every single month because perhaps it goes beyond this threshold, then it will become a type of mixed cost with a fixed portion and a portion of variable cost. Okay, let's take a look at an example. Let's try to look through these 1 to 5 and see if you can classify them into the different types that we just talked about. So what is units of production on routers used to cut wood enclosures? This will be variable. Remember, units of production, the more miles we're using the truck, the more cost incurred. So here, depreciation for this units of production is not straight line. It's considered a variable cost. Okay, now the materials used for this. Now this company is building innovative speakers for home, for theaters. Wood that they use is considered a material cost. So what is the idea of material cost? How is it classified into those 3 categories? Materials costs. Think about job orders. If you have 3 job orders, is the material cost the same as 1 job order? This will be actually, we consider it as a variable cost. Okay, because the different materials, you will have different prices, and also the idea is that the more job orders that comes in, you're accumulating based on the number of jobs. Process costing. Process costing, you still materials, as long as it's the actual physical parts of the products, then the more you need to produce for customers, the more you're accumulating. Process costing is just separating the way we assign costs into department-wise, not job order-wise. But how you add, the total material you add up is the same. Okay? So, wood for speaker enclosures will be variable costs. The more you use, the more costs incurred. Patents on crossover relays. Now, patent is a fixed cost. If you innovate something new, you request for patents and the right to use this item or copyrights, these are all fixed costs. Okay, now here's another type of compensation. We talked about full-time employees having a fixed salary rate, but some of the salesperson, their salary will be determined on a fixed salary plus commission. So this is mixed because the more sales they're able to make, then the more money they're receiving. Okay, more salary they're accumulating. Now crossover relays, again, some of the devices that you use for your products, this will be considered variable. So as long as it's the thing that's a part of your final product. Remember, this is designing the theater, designing the systems. Material costs are all considered variable costs. It's the things that I believe connects to the theater systems. Okay, I'm not an expert in this area either. I also actually did a search myself. So it's basically the device you use in the theaters. Okay, now we have a few more. This will be obvious. This is number 6. Straight line depreciation, fixed. Okay, good. Grill cloth, variable, again, a type of materials that the system uses. Cell phone costs, mixed, we just talked about this. Mixed, cell phones. Remember cell phones we just talked about, it could have a fixed rate. Of course, if you're talking about some of the very special plans for travelers, then probably it's all variable costs. But for the general sense, you will have a fixed plan, and then the portion that goes beyond it then becomes variable costs. So it's a mixture of both. Glue, again, a type of indirect materials, is considered variable cost. Quality inspector's salary. The answer here is fixed. I wanted to point out that if this is a full-time employee, it's considered fixed. But if it's a part-time employee that you hire just for certain jobs, then of course the more number of jobs that you ask them to hire to inspect on, the more cost incurred. So this could be both. But in a general sense, if this problem is assuming it's a full-time employee, then it will be fixed. Yes. You go first. Okay. That would be similar to the example of equipment rental cost. Every time you rent the equipment, it's $15. So you're talking about every time you purchase a box. So the variable rate is the same, but remember, it's related to the number of boxes that you use. So as long as it's related to a certain amount of activities, that will add up to the total cost, and it's considered variable cost. So what is, again, fixed cost? The whole year you depreciate $200. Regardless of the boxes of glue that you purchase, you still have to depreciate $200. Okay? Yes? So that's why I said this one here, if it's fixed, it's assuming that it's a full-time employee. So usually if it's part-time, the problem will say part-time. If it's a part-time worker, a lot of times it's based on the number of hours they worked on a certain job. Then that would be the idea of variable cost, because it's based upon the number of hours. Okay? Yeah? If that is like a fixed rate that is already set, it's not like they can decide upon how many hours. If they go beyond, if that contract is saying that if you go beyond this, we're not paying you more, then that would be a fixed cost. That basically is similar to a full-time employee's idea. Okay? So, but if it's going beyond, they don't know what is the expected number of hours for this job, and the more they are able to work on, the more you're being paid. So a lot of the work studies here. The more they work on a certain professor's project, the more they're getting paid. That is not a fixed salary, right? If they're able to spend more time on it, they're getting paid more, and that's considered variable cost based upon the number of hours. Okay? So maybe it's a little confusing. Fixed cost is fixed in terms of the total amount. Okay, remember the total amount of fixed costs, earlier examples is $12,000. Variable cost goes up and down, but it does have the same rate that it goes up and down for, $15. So for every event you incur $15, every event you incur $15. This is a portion that is stable for a certain range, but remember this is accumulated based on number of events. This is not accumulated based on number of events. So think about the sales activities. If you ask yourself, based on the sales activities that happens, is this cost going to go up and down based upon that? If it's not going up and down, it's a fixed cost. Okay? The number of materials, the materials that you use, the more jobs that you've requested from customers, of course, the more materials that you will be requesting, so that's the type of variable cost. It goes up based on job orders. Okay? We will be going over a few more examples a little bit later. Now, speaking of mixed costs, there's a way to do budget for mixed costs based upon early seasons information. You may be able to budget future seasons information based on this high-low method. Okay, we're still under the category mixed cost here, but we're introducing you a way to do budgeting, to do budget for mixed costs for future seasons. Okay, so there are 3 steps to do this. This is assuming that you have information from prior seasons. Like earlier, we had 15 events and 225 costs for equipment rental. Those information, if you're given a certain level of past information, you will be able to, at the end, calculate a equation for you to do future budgeting, meaning after selling certain units, what is the cost that will be accumulated? If I expect later on there will be 100 or 200, based on past information, how am I able to expect the future cost that will be accumulated? Okay, so when you look at a few tables of information, just like earlier, the 3 months of information, first of all, calculate the slope. Okay, how we got the slope again, differences in x-axis and the differences in y. So earlier we talked about 20 minus 15, and then 300 minus 225. So we already got this idea from variable cost. That basically is step 1. Calculate variable cost per unit, because remember, mixed cost has a portion of variable, has a portion of fixed. Okay, I'll go over the step part and then we'll apply it to one of the examples. And once you have the variable cost, you already know it's $15 per rental of equipment, and you have the data points earlier. The data point means 15 events, you have 225 equipment rental cost. 20 events, you have $300 of rental cost. You have this $15 rental cost per event. Just apply it to any of the data points earlier you got to calculate the fixed cost at the end. So meaning $15 per event. If you know this month we had 15 events, you know the variable cost is 225. And the total cost, of course, of mixed cost earlier, we'll be adding a fixed portion. How are you getting the fixed portion? It will be based upon subtracting this 225 by the total cost of the information. Okay, so the second step here, you get the slope first, apply it to any of the data points to figure out the total variable costs. Then this total cost incurred from past season, this is a fact that you will know based on the information from previous months. Use this to minus the total variable cost to get fixed cost. Remember, we're talking about mixed cost over here. It's a portion fixed, a portion variable. Get the slope, plug it into any of the data points to figure out total variable cost, and use it to minus total cost to get fixed portion. And then just put all the information together. That becomes an equation that you can use for budgeting purposes. Okay, we're going to apply it to one of the examples, so it will be more clear when you see the numbers. So the high-low method, the high and low means that you can pick from the total cost information for different seasons, pick the ones with the highest cost and the ones with the lowest cost as a starting point. In reality, you can actually use any 2 data points because remember, as long as you have 2 data points, you can figure out the changes in X, changes in Y. But the textbook suggested to use the highest and the lowest just to figure out just in case in the middle there were other data points that wasn't as accurate. The highest and the lowest, you'll be able to figure out what is exactly the slope of the entire year or different years. So it's better to refer to the highest and lowest point. Okay, so let's take a look at this example. You have different quarters of information on certain events playing hours. Remember, we were referring to a DJ services company. And let's say they have been using certain equipment for certain hours and they have to maintain the machine or maintain certain instruments. So this is the information of using the equipment and the cost of maintenance that incurred. So you can see the first quarter events have been used. Event playing hours is 360 hours and we incurred maintenance costs of 1,720. And the second quarter, 415, you have obviously more cost incurred because there were more hours being used for that instrument or equipment. 480, even more cost incurred. And then the fourth quarter backed up to 240, so you can see that it has the least maintenance cost of all 4 quarters. So if we were to pick the highest and lowest point, again, the highest cost and lowest cost point, it will be the third quarter and the fourth quarter. Okay? So based on this information here, again, we're looking at mixed cost category. Mixed cost has both of variable and fixed cost. If we look at these numbers, can you tell me how we are able to calculate the slope? And then which one will be used to divide which? So the changes in the cost will be the y-axis, right? And then the changes in the event hours, remember earlier it was using the equipment, number of events will be the x-axis. So we have 480 minus 240, use this to divide 1,960 minus the lowest point, 1,480. So this will give us 240 for the denominator and numerator 480, right? So this will give us 2, and what is this? So the maintenance cost per hour. When we use the equipment for an hour, we have $2 of maintenance costs incurred, accumulated. So this is a variable portion. Remember mixed cost, the variable portion has a rate that goes up. The slope would be $2 here. So you already figure out this first part here. We have $2 as the slope. You can actually do any two data points, okay? So if you pick any other ones, 480 minus 415, you can get the same slope, $2, okay? Okay, so what happens after this too? Remember at the end we want to get to an equation for budgeting purposes for later on, so we need to know also the fixed cost. So just by this table, it doesn't tell us what is the fixed cost, but we can figure it out after we calculate this slope. So how do we use that number, $2? $2 is a variable cost, and if we pick the fourth quarter, let's say, we know that the event hours is 240, and this is related to $2 because 240 hours will incur, for each and every hour, you incur $2. So 240 hours, you will accumulate how many variable costs? 480, right? So the slope is $2, and we have just selecting either one of the quarters information, the fourth quarter, let's say. 240 multiplied $2 will give you the total variable cost, 480. So you pick the two data points, calculate the slope first, and then plug the slope into the variable cost unit, 240. Multiply by 2, you get the total variable cost, $480. And then how do we figure out what is the portion of fixed costs for the fourth quarter? So the total cost is an addition of fixed cost and variable costs, and the total cost is 1,480. And now we know the variable cost is 480, so what is fixed cost? Not getting me. Okay. Total cost is how much for fourth quarter? 1,480. And we just calculated the variable cost. It's 1,000 fixed cost, right? Because the variable cost is 480. We use the slope to multiply the number of hours being used, 480. 240 multiplied 2, yes. $2 from any quarter. We get the fixed cost by using the total cost minus the variable cost. Okay, so the total cost for the fourth quarter is 1,480 minus 480 variable cost. You can get a fixed cost for $1,000 for the fourth quarter. And does it work for the third and the second? We can do the same calculation again. We know the slope, which is the variable cost that we'll use for each and every quarter. The third quarter, we have 480 hours. So we multiply this by $2 to get the total variable cost, which is $960. And then the third quarter total cost is 1,960. This is total. We minus the variable cost. This will give us the fixed cost portion, again, 1,000. Okay, same works for the second quarter. Second quarter, we have 415 of events hour that incurred. Every hour will give us $2 of machine maintenance cost. This is the variable portion. So we have 830 variable cost. And then the total cost for that season is 1,830. So again, your fixed cost is $1,000. So remember, this is the fixed portion, so every season it's the same. Okay, so if you put all these information together, you should be able to get a general equation just based on these data points. Total cost would equal the fixed portion multiply $2 of whichever hours incurred. This is what we're trying to get to at the end. Based on this table, we find out first of all what is the B and then what is the A, and then use this equation to do future seasons budgeting. This will be the total cost at the end, right? Step one is the slope. Just the equation itself, yes. Yes. Okay, step one, we're trying to figure out the slope, the $2, based on picking whichever 2 points the textbook suggested, the highest and lowest point. Okay, so the differences between x-axis and y-axis, you can figure out this $2 first. Then plug it in any data points. So you have the total variable cost, then use it to subtract the total cost to figure out what is the fixed portion, and just put it together in an equation. So what is this useful for? Meaning that, let's say the fifth, or next year's first quarter, we assume that probably it's a low season, we will only be using the equipment for 100 hours in the events. So in this case, the budgeted total cost would be 1,000 plus the expected 100 multiplied by 2, which would equal 1,200. Okay, so we're using past season to do budgeting. We're touching upon a little bit on budgeting's idea, using past information to see what will be the future maintenance cost incurred. Okay, forgot to list all these. So again, step one, slope of the variable cost. Again, that is a variable cost because the more event hours being used, being incurred, then the more machine maintenance costs will be accumulated. So we find the differences in the number of event hours and the differences in total cost and find the ratio relationship between those two numbers. So it will give us $2, meaning each and every event hours will incur $2 of variable costs, maintenance costs. Then we use this $2 multiplied by any quarter's information. This example here will be the third quarter. So you get this total variable cost, 960, then subtract it from the total cost to figure out the fixed portion. Okay, so each and every season the fixed portion is the same, so you can just use whichever data points. You can also use 240. Multiply by 2, you get 480 here, and then the total cost is 1,480, so the difference is again is $1,000. After this, put all the information together. Can find an equation, total equipment machine maintenance cost, y, equals 2 multiplied by hours, which is the slope multiplied by the units that actually incurred, plus the fixed portion, 1,000. So again, here's an example. Let's say next season we'll be using the equipment for 400 hours on our events. And 400 multiplied by 2, variable cost is 800, plus the fixed portion, 1,000. 1,800. Okay, so to double check this equation, just plug in each and every event's information, see if you get the total cost as the table shows. Then you will know whether you have figured out the numbers right, the slope and the intercept, which is the fixed cost. Okay, before we do the exercise, there's another concept here that links to this idea, is that management level also needs to keep in mind that there are ranges in the fixed costs and variable costs. So meaning if we go back to that equipment using hours, let's say I own a small business that only uses less than 10,000 hours of that equipment in the entire year. But what if a public traded company uses heavily on certain equipment more than 12,000 hours and somewhere below 30,000 hours? Then obviously for this small company and this large company, how the maintenance company will charge these two clients will be different. Meaning even though the fixed rate is $72,000 for my company, perhaps a larger company who uses the same equipment more heavily used in different seasons will be charged a fixed rate higher than my company. Because obviously they're using the machine a lot more than my company, so they'll be charged. It's still a fixed rate, it's just at a different level. Okay, so what relevant range means is that if your company is expanding to a second level using the equipment or certain types of machines a lot more than before, the fixed cost may jump to a second range. But as long as it's within this range, it's still a fixed level at, for example, $144,000. But then if your company expands to an even higher level they have a lot more requests from customers, they'll be using that equipment or machine for a lot more hours compared to early years, then this fixed rate will be charged to a second relevant range or a third relevant range. So meaning that even though this fixed cost is fixed, we talked about that it's stable, but it's only stable within a certain range. If your company expands to a lot larger, we have different corporations that has associations with you have different types of events that does it worldwide. You need a certain equipment that is heavily used, a lot more heavily used than before, then your fixed cost will be charged at a different rate for that range of usage. Okay, so this is just to point out that fixed cost is fixed within a certain range. If your company expands, then the range may be in a different level, then the fixed cost will be charged at a different rate too. But again, it's still a flat rate as long as you're using within a certain range. It's not going straight up by a certain incremental rate. It's not like equipment cost every time the events you rent it, you have $15 charged more. It's still a flat rate, just within a certain range. Okay, let's apply all this to an example. It's easier for us to understand. If you take a look at this problem here, it tells you that we have 2 months of information of utility bill. You have the information for August. Highest bill that occurred is $2,800. And this utility bill links to a type of machine that has been used for 14 hours. Then we have another month of information, lowest utility bill that occurred in December, $2,600, and then that links to machine hours 900. Okay, so you have machine hours as the x-axis, you have the utility bill cost as the y-axis. Try to first of all determine what is the slope for this variable cost, for this utility bill. Now, if you got the slope, try to figure out the fixed costs, and if possible, put together the equation. So try to do step 1, 2, and 3. Okay, so if we take a look at this example here, if we want to plot this, it will look something like this. We're talking about mixed costs that already assumes that we have a portion of fixed and a portion that's considered variable. Okay, so the variable portion is the part that we're dealing with first. Let's say that we have 900 hours of using the machine, and we also used it in the other month, 14 hours. This incurred a cost at a level of 2,600 and 2,800. So if we want to figure out the slope for this graph, again, it's the increased rate for this variable cost. We'll be using the differences between the number of hours of usage and the differences between the cost incurred in these 2 years. Okay, so we'll be calculating 200 over the 500 hours, which will give us a rate of 0.4. So this 0.4 means per hours of using the machine or equipment, we incur the utility bill 0.40 cents. Okay? So what do we do with this? This is step 1. We got 0.4. What's the second step? Multiply by any points. Okay, so let's just choose 400. So if we use 400 data points, I'm sorry, yes, 1,400, thank you. 1,400 hours multiplied by the rate 0.4, should be able to get 560, and this is the variable cost, right? So the total cost we know is how much? 280 is the total cost, and the variable cost is 560, so we should be able to get 2,022, yes. Okay, so this $2240 is the fixed portion of this equation here. So if we want to put it all together, it would look like the total cost of utility bill would equal the fixed cost portion plus the variable cost rate multiplied by hours. Okay, so the differences in using the hours will cause us to have a different utility bill incurred. Just find whichever two data points, which this problem only gave us 2, the differences between the hours, and use it to divide the differences in the total cost to figure out the slope, which is the rate of variable cost incurred. So this slope here, just plug it in any data points to figure out the total variable costs, and then minus from the total costs to figure out the fixed portion. Okay, so if you were to plot this in a graph, this portion here is the fixed cost that no matter how many hours the machine has been used, you will incur this cost, $2,240. Okay, so again, the purpose of doing this, we want to find a way to do budgeting, right? Budgeting for these type of costs. So here's another problem that links to this. If we anticipate this business will be using 1,200 machine hours in the next month, based on this year's information, what would be the expected utility bill? So we have the equation done from last year's information, and we expect that this can be applied to next year as well. And we expect we were using the machine, 1,200 machine hours, and what would be the cost incurred? 2,720, and you got it from, okay, 40 cents and multiply by the machine hours. Okay, so 0.4 multiplied 1,200 will give you 480. Okay, so 480 then plus the 240 would give you, okay, 2,720. Now this equation, as I said earlier, we have different relevant ranges in the business. So this equation is only useful for a certain range. Imagine if the company expands to the second range, they may have a fixed cost that no longer is $2,240 and may be, for example, $3,000 if the machine hours exceeds its usage to, let's say, 3,000 hours regularly in a year or somewhere around that number. Okay, so this equation is only useful for a certain relevant range. If you bump into the second range, perhaps the variable cost would also be increased to $1 per event or $1 per machine hours being used. You will have a different equation. Okay, so this is just the basic idea of how we decompose the information in mixed cost. If you just look at the bill, are you able to go backwards and figure out how the information is being captured, being calculated? Okay, now the next one here, I'm just going to show you what the data points would look like. So we had 2 months information from the problem, and then we just calculated the one with 1,200 hours. So were to plot it, it would look like this. And again, it doesn't start from 0 because this is the fixed cost portion. Okay, then in the upper part, the reason why it is graphed that way is because the slope is 40 cents. Of course, if the slope is higher, the graph will be steeper. Okay, if it's lower, it will be flatter. What is the thing that you said you're going to write instead of this?
Yeah, like instead of doing the equation that goes on we use that equation.
Oh, you mean like y?
Yeah,
Y equals ax. Well, the idea is the same. If you put it down, well, the problem probably will be asking what is the total cost or what is the equation. If you put it that way, that's fine. I will understand. Okay. But chapter 19, just for clarification, is not a midterm one. So don't worry about this until the second midterm. But I want to go through some of the concepts for next week's homework.